In 2020, our revenue went up by 880%. Our volume went from 2019, which was $4.5 billion, to 2020 over $24 billion. So volume went up by 500% over the past 2 years for an average mortgage. The amount of refinancing volume has come down by almost 99%, so which is pretty significant. The biggest failing was not recognizing how much the fortunes of the company are tied to the macro market and the interest rates. The first thing I was thinking was, as the leader of the company, I should take responsibility for the fact that we're now downsizing. I wasn't going to hide behind an HR person. 80% of the mortgages that we do today are one-day mortgages. So it's not a gimmick. It's not like something that applies to like 5% of the mortgages we do. Over 80% of the mortgages we do today are one-day mortgages.
Hello, everyone, and welcome to Fintech Leaders, coming to you from New York City. I'm your host, Miguel Armaza, and I'm a co-founder of Gilgamesh Ventures, a venture capital fund that backs early-stage fintech entrepreneurs in the US and Latin America. If you enjoyed this conversation, I invite you to leave a review on Apple Podcasts, Spotify, or wherever you get your shows so more people can learn about fintech leaders. In this episode, I sit down with Vishal Garg, CEO and founder of BETR.com, a publicly traded online mortgage lender that has funded over $100 billion in mortgage volume in the last decade. Prior to going public in 2023, they raised capital from a long list of VCs, including Activant, Softbank, AmEx, Citi, Goldman, amongst others. In this episode, we discuss how BETR's business volume exploded in 2020 and 2021, but later dropped 99% in a matter of months, going from 1,500 to 10,000 total employees within almost a year, and then having to lay off most of them. An inside look into Vishal's controversial decision to let go 900 people over Zoom, BETR's latest product innovations, the current state of the residential real estate market, and a lot more. Vishal, welcome to Fintech Leaders. How's it going today?
It's great, Miguel. Thank you so much for having me on. I'm delighted to be here.
Yeah, I'm excited to chat. I know we tried in the past a few years ago and we couldn't make the schedules work, but I'm glad we're doing this finally. Vishal, I want to start by hearing your perspective about the current state of the residential real estate market in the US. We're going to talk obviously about BETR and the story and the ups and downs. But before we go to that, tell us what's going on today in residential real estate.
Yeah, so the past 2 years have been brutal for residential real estate, and particularly prop tech and fintech in residential real estate. Yeah, as you probably know, because of the interest rates going up from basically 3% to as high as 8% over the past 2 years for an average mortgage, the amount of refinancing volume has come down by almost 99%, so which is pretty significant. Like, imagine if like the demand for pizzas went down by 99% and you're a pizza company, right? What would you do? So that's like for the refinance side of the market. On the purchase side of the market, demand is off by about 40%. The number of new homes sold is tracking to something like 4 million versus the 6 to 7 million that we saw during the pandemic and afterwards. So we're in a heavily challenged market. That being said, there are silver linings. There have been people who have been on the sidelines for 2 years, 3 years looking to buy a home and waiting for the rates to come down, where now they finally feel confident that even if rates don't come down, they're not going up some more. So they're trying to dip their toe in the water, taking advantage of what they see. If they see a house that's for sale, that's the house that they want to live in, they're making the bid and they're pushing to buy that house. They're stretching to buy that house rather than waiting. So we're starting to see some really good silver linings there. I mean, for us, volume is up 50% in terms of funded loan volume that we're expecting for this quarter compared to just 6 months ago. And I think we're like a leading indicator as to what's happening in the market. So in 2021, when the market was softening, we felt it first as the leading online originator. And now as the market is thawing, we're seeing it first come in terms of demand.
Interesting. And just want to go back to the 99% drop for refis. What's driving that remaining 1%?
They might have a mortgage that's over 8%, or that they might have gotten before the global financial crisis, or they just need to move, or they just need to get cash out of their home. And so if they've got a lot of equity in their home, but they need to pay off their credit card bills, they need to pay off, send their kids to college at 7% or 8%, still cheaper than a credit card, cheaper than a personal installment loan. So they'll take cash out of their home rather than do one of those other things.
And the 50% rebound that you're seeing in activity, is that this year, 2024?
That's this year, yes.
And what's the profile of the buyers that you're seeing come in this year?
The profile is an average American family with decent credit. They're still putting down on average around 8%, right? They're not putting down 20% or 30%. They're putting down an average of 8%. Their debt to income ratio, which used to be, let's say 30%, is now more like 35%. So they're stretching to afford that monthly payment. But, you're seeing activity, and the activity is more concentrated in areas of the country that's more affordable, like the Southeast and Southwest, Texas, Florida, North Carolina, where both taxes are lower and there's a lot of housing development going on. And the availability of an average $400,000, $500,000 house is just much more higher.
So, Vishal, take us through 2020, 2021. BETR volume was just exploding. You were doing tens of billions in originations. And then you started to see this drop, I suspect completely inversely correlated to the rates that were rising, right? And then kind of you said it, 99% drop. I mean, tell us, how did that feel internally? What did you see coming? What were the first steps you did in anticipation?
So as the leading online mortgage originator, we really benefited from the pandemic. Rates went down and banks closed, right? So you couldn't walk into a Wells Fargo branch or a Chase branch to go get a mortgage, right? You didn't want to go and meet your traditional mortgage broker in their branch. And so people went online. And when people went online, they came to BETR.com. And BETR.com would give them a pre-approval in 3 minutes, allow them to lock their rate in 15 minutes. And we were able to scale so dramatically. So in 2020, our revenue went up by 880%. Our volume went from 2019, which was $4.5 billion, to 2020 over $24 billion. So volume went up by 500%. So it was an extraordinary time. We made over $200 million of profit. And so what we were able to do at that point in time was meet the consumer demand by scaling. And look, our systems were not really built for that level of volume. Like, nobody's systems are built for like volume exploding by 900%, right? Or over the course of a 2-year period, or volume basically, and revenues and people. And so we had to supplant that with a lot of people. And so wherever the system, the automation, the rules engine dropped off in the process, we had to supplant that with people. And what happened is we hired. So we went from 1,500 employees to 10,000 plus employees. Half of them were in India and half were in the United States. The India side did all the back office processing of the mortgages on a 24/7 basis that deliver the speed for the consumer that we're famous for. And then on the flip side, our customer support team expanded dramatically because people wanted to know where the mortgage was, or they wanted to lock their rate, or any of those sort of things that you still did on the phone. So here we are, it's 2021. We're now going from 20 plus billion of volume in 2020 to 60 billion of volume in 2021. Really blitzing again, right after just having done that and trying to meet the consumer where they were. In the first quarter of 2021, we made almost the same amount of money that we did in the whole of 2020. So it was insane. We were like on a $150 million profit run rate as a company. And what we started to see, though, was inflation creep up in mid 2021. And with that, the 10-year bond creep up. And when the 10-year bond started creeping up, we started to see demand was falling off because people who had refinanced and then were refinancing again and were refinancing again. And at that time, 95% of our business was refinance mortgage. So we saw demand contract. As demand contracted, we started to see the cost of buying leads start to go up. And then as the cost of buying leads started to go up, demand contracting, and we've got this very large team, our unit economics started to suffer. And so we had to do something, and we had to do something pretty drastic. So we said, well, we can do a slow bleed over a period of time, or we can start to take action. And going into the fall of 2021, it was clear that rates were going to start going up, and we were way overstaffed. We were staffed for a declining or steady rate environment. We were not staffed for a going up rate environment, particularly our products. So we had to pivot in many ways. We had to pivot our staffing model. We had to say, wow, all these people that we've hired, we've got to get the machine to do what they do and get the machine to be better. Then with the people that we've brought on, we had to reskill them to go to purchase mortgages from refinance mortgages. And purchase mortgages are a very big difference than a refinance mortgage, because a refinance mortgage, it's easy. You don't have a lot of risk, because your worst case scenario, if it doesn't work out, is you have the same mortgage rate as you did before. But on a purchase mortgage, you're trying to buy a home. It's your largest financial transaction of your life. So you need to know and trust the company that's giving you the purchase mortgage. So we had to be much more accountable to interacting with realtors, much more accountable to interacting with the entire ecosystem of the purchase mortgage, which required a different mindset rather than a customer service mindset. When you call, we'll pick up the phone. It has to be a proactive mindset where when we're going to call you and update you no matter what's happening, just on a regular cadence, and make sure that we can give you the psychological comfort you need. So it almost involved a different type of person working at BETR. So we had to basically figure out who could be retrained and reskilled. And then with the remaining teammates that we had to figure out where they could land. And if they couldn't land somewhere within BETR, then they would have to land somewhere else. And we wanted to be upfront with them and let them know that. So those were the factors we were facing towards the end of 2021.
Yeah. And so Vishal, let's talk specifically an unfortunate kind of day that you had, which is you had to lay off close to 1,000 people, and you did it over a Zoom call. Take us behind the scenes. I know that now you regret how you did it, but what was your thinking? How did it go?
Yeah, well, the first thing I was thinking was, as the leader of the company, I should take responsibility for the fact that we're now downsizing. I wasn't going to hide behind an HR person. I wasn't going to hide behind someone who was the head of operations. And I'd always led from the front. So if I'm going to lead the charge up the mountain from the front, I should lead the retreat back from the mountain from the front as well and take full accountability for that. So that's what I'd wanted to do. Now, there was no way that I could do that individually with each person. And of the 10,000 people that we had hired, 8,000 of them had been hired over Zoom. So they're all spread around the country. They weren't coming into the office so that we could do them in the office. And it would feel almost weird to call someone into the office to then let them know that they didn't have a job anymore. So we tried to do it at the time in the best way that we could, and we knew, and tried to be honest with them and let them know that. Now, I clearly bungled it. I wasn't empathetic enough. I wasn't feeling what the gravity of what was happening and how someone on the other side of that call was feeling when they heard the news. So I could have clearly done a much better job. And I think we know that. We've downsized further since then, and we've tried to do a good job at figuring out how to do that. But I also think that a lot of companies have come after us and tried to do similar things. And we're all sort of still figuring out what it means and what the employer-employee relationship and the dynamic of interpersonal relations means in the post-pandemic era.
Let me ask you one thing, Vishal. A lot of founders have gone through restructuring their companies, a lot of leaders, and the advice that you get, and then it's easy to give out advice. The advice that you get is you better cut deep in one swoop and then avoid having to do it multiple times. Rarely does that happen. Most companies do more than one round. That was the case for you. You did multiple rounds. Do you regret that? Was that inevitable? What would you advise to other founders that are going to go through it?
I feel like the market deteriorated before our eyes. So I think the biggest failing was not recognizing how much the fortunes of the company are tied to the macro market and the interest rates. And as rates went up, rates tend to either go down or they tend to go up or they tend to stay the same. But once they kind of establish a secular trend, right, the market, like our total addressable market for refinance was just shrinking, and it was shrinking pretty badly. And so what would have been smart would have been to do a lot of the cutting right up front, anticipating not what interest rates were going to be in the next quarter, but anticipating what interest rates were going to be in a year or 2 years from there, and then sizing it accordingly. Now, if I had that crystal ball, I would have bought interest rate futures and I would have made a ton of money too, right? But we didn't have a crystal ball at that time to be able to figure that out. So then the next question I ask myself is, would it have been better to cut all at once? And I say, if we had done that, then we wouldn't have been able to still serve the customers that we served on the steady decline in revenue that took place and the steady cost cutting that took place after the first thing. We wouldn't have served as many customers. Two, we wouldn't have kept people as employed for that time, right? So we were able to give gainful, meaningful employment to a whole bunch of our teammates for a lengthier period of time by continuing to serve the customer and being open for business. So I would say those are the two things that are the counterbalances to cutting deep and cutting once, particularly in a macro interest rate sensitive business like mortgage.
Yeah. And from your point of view, what does that do to the culture of a company going through this process?
I think it's super difficult for the culture of the company. I think it's super difficult until you hit rock bottom and the people who are there know that they're there and that they have security. I know a lot of founders listen to this podcast. And so I think that we think that everyone has the same incentive structure as we do. But being a founder itself is a radical choice, like actively acknowledging and going into an activity where the chance of failure is like 90%. 90% of startups fail. It takes a different person to do that versus someone who's working at a call center or in customer support or in operations. They're looking for certainty. They're looking for security. For them, it's a very meaningful thing to lose their jobs. And so I think until you can provide that security, it's very hard for the culture. I think the best thing you can do is provide transparency and honesty. Hey, why are we doing this? What's happening? And I think we tried to do that. I tried to do that right from the beginning in transparency and honesty. I was like, the market's getting really bad. Demand is falling off a cliff. It's going to be really brutal. When I first said those things in December of 2021, people were like, what do you mean? Life is so great. This is amazing. Unemployment is at like all-time lows, all this stuff. The startup economy is booming. Crypto is booming. All this stuff was like booming during this time. And I was like, wait, I have some bad news. And so I think people were surprised about it to hear that. But then as I kept on saying it, I think people understood. And then honestly, once we got to a place where it was steady, then the culture started to improve. And now for 2 quarters in a row, we've had growth and the culture is improving a lot. We've been able to bring a lot of our old teammates back into the same roles. So we've brought back over 55 people who used to work here. And we continue to do that and give them priority when they want to come back. So that has really helped the culture.
So you actively spend time thinking about culture. Was that something you did earlier on or is that more recent?
I would say for the first 8 years of the company, I did not spend time thinking about the culture. I spent time growing the company and thinking about the consumer. I was thinking about the consumer with 90% of my mind space. And I think that's what allowed us to be successful, right? Was this relentless focus on the consumer in an industry where everyone is focused on profits or rules and regulations or enhancing the friction in the process. We were thinking about how to lower friction for consumers, how to deliver savings for consumers. And I think that's what helped build the company. I think as it got to a size and scale of 10,000 people, though, it required thinking about culture. It required being very thoughtful with the different type of person that was coming and joining the company, right? And what their risk tolerance was and what their capability to fully understand what was happening in the market was. And I think that was something that we missed.
And for early stage founders, do you advise they start focusing on culture from day one?
I think you should start thinking about what it means as you get bigger. I think it would be ideal. But look, the pandemic was, a once in a lifetime event, right? Companies that grew during that pandemic and grew several 100% in 1 year, it's very hard for any culture to absorb that type of growth. Imagine if instead of 300 million people in the United States, we had 1 billion people next year. The culture of this country would be very different. So I think it's just, when you think about it, you can plan for it, you can put some stakes in the ground, you can explain to people more upfront of what the job requires and what it entails and what it means to be successful, I think those things will help because people hate being surprised.
Vishal, switching gears a little bit, when you talk to investors, specifically VCs, investing in credit-driven businesses is not something that's popular amongst the majority. And then those that do invest in credit, they often say, oh, we're going to invest in off-balance sheet businesses. That's what you feel. But there's other businesses that do it on balance sheet. They might offload a little bit to capital markets, but it's mostly on. How do you think about the difference of the two? If you had to do it all over again, would you build a more on-balance sheet business? Maybe share a bit of your thoughts about that.
Yeah. So I think the off-balance sheet model, it means that your business is more volatile, right? Is more exposed to market cycles. That means on the way up, it's better, right? Because you have velocity, because you don't have money tied up in assets or a servicing book. But when the markets turn, the assets generate and throw off cash flow, which can help you sustain losses and offset the losses. So if you look at the mortgage industry today, the only people that are making money in the mortgage industry today are people who held the assets on balance sheet, right? And they're just clipping a coupon. Now, their origination businesses are losing money, but they're making money because the coupons they're clipping from, let's say, the $400-500 billion of assets that they have, like, let's say, a Rocket or a UWM, it overshadows the losses they're making in their origination business. I think as a startup, if you can have a off-balance sheet model, the validation that you get from an off-balance sheet model, the discipline that you get from an off-balance sheet model, you are getting paid for the value addition that you are providing. And you're not making money off of a spread. You're making money off the value that you added to the product. So you made a loan at 100 and you're selling it for 103. That $3 is your value addition. It's kind of like, it helps you make much better business decisions than if you bought $100 of loans and you're collecting $9 and then it still costs you some money, and it's really complicated. And I think that's why VCs understand that after having invested in 2 cycles of fintech, the sort of 2000s to 2008 cycle for fintech, and then the 2012 to 2022 cycle for fintech. I think VCs understand that, and they prefer the off-balance sheet businesses for a reason.
Now, one thing that you have been focused on the last couple of years is going public, and you got it done. It took a while. I'd love to hear the road to going public, whether you would do it again or not, would you SPAC or not? Maybe give us some visibility into that process.
Yeah. So, I mean, we had a choice. Our growth rate and the investor base and the quality of the company and the profitability that we had going into 2021 meant that we could go public or do a SPAC. We chose to do a SPAC because we thought it was fair for all investors. Whereas in a public offering, you typically have a couple of institutional investors selling and so on and so forth, and then the rest of people are locked up or whatever. We thought it was a fair process, and it led to better price discovery to do a SPAC. That was the intellectual basis for us doing a SPAC. It also allowed us to raise a large sum of capital in an interim period, whereas like a public offering would require us to raise capital just at the time of the public offering. So those are the reasons we chose the SPAC. Obviously, the process took 22 months. So I would not recommend that, because basically during the period of time we were out there with our SPAC, the SEC suddenly went from blessing the bulk of SPACs that got done to blessing none of the SPACs that got done to be out there in the public market. So the process took longer than we ever anticipated, but it was critical for us to get the SPAC done because it unlocked another $565 million of funding for the company. So we went public at the absolute worst time in the past 3 decades for a mortgage company to go public in August of 2023, when the market was absolutely hitting bottom and interest rates were hitting like 8%, 8.25%. So the post-SPAC performance of the stock has not been something that I'm proud of, but the fact that we got it done, we persevered through it, that we got the capital we need to build and continue to serve customers, those things were accomplishments that we were able to get done.
How has it changed the company now in the last 8 months that you've been public? I mean, now it's quarterly reporting. Now it's different, right?
It's different. I think there are a lot of rules. I think there's a lot more process, but it's also made us better because we are more focused as a company. So when you have more transactional friction, you can do less transactions, right? So instead of doing 5 ideas at the same time, we're doing 3 ideas at the same time. Instead of doing 3 ideas at the same time, we're doing 1 idea at the same time. So it's really engendered a degree of focus. We've embraced it. And that is what's been helping us to get back to growth.
And speaking of growth, tell us about your products, especially the one-day mortgage, right? What are the implications of a one-day mortgage? I think millions of people have gone through the process of getting regular mortgages. It's never one day. So share a little bit more about your product.
Yeah. So a one-day mortgage allows you to go from clicking on our website to getting a commitment letter from us in one day. On average, it's taking about 8 hours for our customers. And 80% of the mortgages that we do today are one-day mortgages. So it's not a gimmick. It's not like something that applies to like 5% of the mortgages we do. Over 80% of the mortgages we do today are one-day mortgages. So we pioneered this offering. We leveraged machine learning and our rules engine to automate almost all the back-end processes that get done in the mortgage. And that enabled us to start offering this to consumers. And we launched it in January of 2023. People were like, how can you do that? That doesn't sound possible, right? It sounds gimmicky, and we've been proving them wrong. We've done billions and billions of dollars of them, and we're delivering on our customer promise, which honestly, from an unlock perspective, really unlocks the housing market for anyone who needs to borrow money to buy a house. So it allows you to compete against a cash offer. It allows you to compete against an iBuyer. It allows you to compete and, effectively get money in hand and know that you're going to be able to afford the house the same day you go into contract on it, which is super unique and super powerful for consumers.
And you mentioned that a lot of this process is being driven by automation. How has, the last 2 years, while it's been challenging in many respects, especially the last year and a half, Gen AI has been providing a lot of fuel to the tech industry. How, if at all, does this change what you do? How do you think about implementing all these new technologies?
Yeah. So the initial product that we launched at BETR was a rules engine built on top of a supervised learning network. And the difference is between a supervised learning network and an unsupervised learning network, which is what the Gen AI stuff is their guardrails and their decision pathways. And so what we have been building is like the first true machine learning driven mortgage company. And we've been building that since 2014. So we were at the forefront of it. The new language models that have been introduced help take tasks that were complex tasks, things that would have required multiple hops on and off with the human in the loop, right? Where the machine tells the human, I've computed these 3 things. I need you to go find this piece of data, this other piece of data, this other piece of data from this website, and calling the consumer and doing this thing, compile the 3 of them and put them back into the machine. Those tasks are the tasks that now Gen AI is going to be able to do for us. And so we are working on some of the more complex tasks getting done by machines, leveraging large language models and multiple interaction nodes in the mortgage process that used to previously be done by a skilled underwriter or a skilled processor of mortgages getting paid $180,000 a year. Those jobs are now the jobs that the AI is doing for us.
Do you pay any attention to what's going on in other markets around outside the US, or is the US just too big for you to even pay attention internationally?
We do have a subsidiary in the UK where the market for mortgages is about 1/6 the size of the market for the United States. But we're just focused on the US market really right now. There's so much runway for us. Our loan volume is under 1% of the market share for the leading digital player in the market. And so we've got to get back to like 1%, 2% market share, 10% market share before we go out to other parts of the world.
So Vishal, how about the next few years? I think you've given us a little bit of a glimpse of what you're thinking going forward, but where do you see the company evolving? Where do you see yourself as a leader evolving in the next few years?
I think I've got to become a leader of a publicly traded company. I think I was a hard-charging entrepreneur for like 7-8 years. And I think the leader of a public company has multiple constituents that they have to deal with whereas the leader of a hard charging private company basically has their customers and their investors. And I think we were very good at servicing our customers and our investors and helping build wealth for our employees in that process. So now it's about dealing with multiple constituencies and learning how to do that. With respect to the company, I think the company's growth prospects are amazing. This is a company today that is less than 1/10 the size it was of its peak. The systems are built. The technology is way better than it was 2 years ago when we were at our peak, and the market's going to come back. So whether the Fed cuts this year or cuts next year, at some point the Fed is going to start cutting. And I think there's some amazing growth prospects ahead for the company when that happens. And then even if the Fed doesn't cut, we've figured out how to do purchase mortgages now. And that opens up 4 million transactions a year to us, of which our market share is way under 1%. So we've got a lot of growth ahead of us.
Are there any other products that you wish you guys were launching or that you're thinking about?
We've most recently launched a home equity line of credit product and a home equity loan product. And we think those products are growing at double-digit rates quarter on quarter. So the demand for that is off the charts. And so between the home equity products that we have and the mortgage products that we have, we're going to be focused on improving our products rather than launching new products.
Vishal, before I let you go, any books that you often recommend? I don't know if you're a big reader or not.
Well, if you're going to do startups, I recommend The Hard Thing About Hard Things by Ben Horowitz. I think I read it first when I started Better. And then when I went through the process of having to downsize and go through the past 2 years, which were pretty dark period for us, I would read that book every 6 months because it would just give me the boost I needed to know. Because when things get tough, there are people who can survive that and come out the other end. And those are the people who end up thriving. And that book was just amazing to read during the tough times.
Amazing. Amazing. All right, Vishal, thank you for doing this. Thanks for being open and transparent. And I appreciate you taking the time to be here.
Thank you, Miguel. Really appreciate everyone listening, and thank you.
Thanks for tuning in. I hope you enjoyed this great episode with Vishal Garg, CEO of BETR. If you want more interviews, make sure to subscribe, follow, and leave a review on Apple Podcasts, Spotify, or wherever you get your shows. It helps and means a lot. And if you have any suggestions or thoughts about the show, just drop me a line on Twitter or LinkedIn. Signing off till next week, I'm your host, Miguel Armaza. The Fintech Leaders podcast is for informational purposes only and should not be considered financial or investment advice.